So please give him all your ears. Listen to what he has to share with us, so that it will help us do our taxation and our accounting and finances proper in the UAE. Second thing is, the Gladiators policy of doing a referral shower is that we ask as many questions as required, so that we can pass on 2 quality referrals to Mr. Altaf at the end of this. So any questions you have, please ask. You will get complete clarity, which will then allow you to pass on some great referrals. I'm going to allow Mr. Altaf to take over. So all the best, sir.
Thank you, sir.
Let's have a good one.
Good morning, everyone. Good morning, my brothers from BNI Gladiators and esteemed guests that have come. And hopefully quite a lot of some other people are still on the way. So we should expect more audience. Thank you, Mr. Ansar, for coming. As you already know, the whole idea of having this particular session is to allow you to ask questions. And I will, before you ask those questions, I am going to give you some heads up, some things that people might not be aware of in their when they close their first calendar year. So once I have given that overview or considerations that the taxpayers need to account for, after that I will give the floor open to you, so that you guys, whatever specific queries that you may have, you can ask them. So why is this event so important? Let me ask you as well. Why do you think this particular December is so important from the perspective of UAE corporate tax? Anybody would like to answer that? Share your perspective. Why is it so important? Why this December is so important?
Because from Jan onwards, corporate tax is effective.
No, sir. Corporate tax has been effective from the last year, actually. Yes. This is the first calendar year after the implementation of UAE corporate tax. This December marks the closure of the first calendar year. Some may argue that there are other organizations with a different year end. So why am I stressing on December 31st so much? The answer is very simple. Yes, there are companies with different calendar years, but 99.9% businesses operating in UAE, even the owners might not realize or know even that their financial years written in their memorandum of association, which is the company's constitutional document, it is actually a calendar year. So 99.9% businesses close their books on 31st of December to begin with. Okay, fine. So some of you might have already become aware that yes, there is something called corporate tax that has been introduced. You became aware in 2023, or even possible that end of 2022, you were already aware that corporate tax is going to start off. So you must have taken some cautious measures, to start doing some strategy, building some corporate tax impact assessment, etc. But a vast majority did not engage into that kind of a consultation discussion with people like me, with other tax practitioners that are there. What they did was they thought that, okay, I mean, our first year will be 2024. So it will start from the January of 2024 and it will end on the 31st December. So we have ample time available. 1 year we have available. Once our year closes, after that we will start off. But little did they know that the planning and strategy of corporate tax does not begin after the 31st December of 2024. It actually started off before the end of the year 2023. That's a surprising point. But why do I say that? I always mention one sentence: get your corporate tax story straight. That's a $1 million sentence for those people who are planning your corporate tax returns. Get your corporate tax story straight. When I say story, that means I'm talking about year-on-year movement. So whatever you did in the year 2023 or before that, you might remember those formally designed financial statements with auditor's report thereon that you've been getting from your finance department over the last few years. Now those reports are going to come into action. They will come into play here. But luckily, small and medium enterprises are fortunate that they are less regulated. If they wanted to change something in their balance sheet or income statements that pertain to 2023, last year, as a matter of fact, they can even do that. Hi, sir. Welcome. No worries. Please take this. So as I was saying, because SMEs are less regulated, the utmost important thing to do is to raise a discussion with those people who understand not only corporate tax, but also accounting side of things, IFRS, etc. So that they will tell you that, for example, in our UAE corporate tax, the first thing that matters is whether my company or me as an individual natural person, am I even subject to corporate tax? I think quite a lot of you have already gotten that answer. That stage we've passed. Okay. Then comes the various, people might have told you there is something called GAR, General Anti-Abuse Rules, that you cannot take actions just to stay within the limits of the law and still avoid corporate tax. That's called anti-avoidance, that is avoidance of tax, which is different from evasion of tax. So that also we have learned quite a lot, maybe. But the key point is, what do we actually need to do now? We are approaching 31st December. So the first thing is, when you raise this discussion with any of the consultants or experts in tax and IFRS, they will tell you, first of all, that, okay, we want to first of all look at your 2023 financial statements. Now, why would they want to look at your 23 financial statements? What they will do is, they will first of all look into the note 1 of that financial statement that provides the overview of your group. How many entities do you have? Like, is it only one company, or there are multiple companies that are there? Why? Because financial statements, even in front of Federal Tax Authority or the courts of law, they are going to play a vital role in determining your tax obligations. So note 1 of those financial statements identifies that this company has been consolidating or combining financial statements of these 3 or 4 or 10 entities. Even if they don't have a parent subsidiary kind of relationship, even if there is only common shareholder, Mr. Mustafa Bhai may have 3 companies in which he is the majority owner or shareholder, right? So are these financial statements, authentically, is it allowed to consolidate them? That's a technical question. I don't want to go into that, but we leave that to the discretion of those who are the experts. But what I'm trying to say here is, even if you don't know about the answer to these technical questions, at least you should know that these type of technical questions may arise. So that is the planning stage. Right now, in the next few days, that's the first thing you guys should do. Start off with your planning process, start raising discussion, and to actually and specifically identify what action you need to do. The action is, take your 2023 financial statements, go to an expert, sit with that expert and ask him, look, I forget about my 2024 financial statements. Look at my 2023 financial statements. Please identify what? Number 1, what are the corporate tax risk areas in these financial statements? When you ask this question, that what are those corporate tax risk areas, the consultant is going to look at your balance sheet. Do you know what would be presented in your balance sheet that could raise concern? I'm not talking about profit and loss account. I'm just talking about balance sheet. Can you guys think of something that would be there in the balance sheet and that could trigger the attention of Federal Tax Authority? Why am I asking these questions? So that I can bring you in the right mindset. Sorry? Withdrawals by the owner, yes, you could say that. Actually, they're in a statement called Statement of Changes in Equity, but yes, indirectly it affects withdrawals by the owner, very right. Any other thing? In the balance sheet. financial activity that you will find either in cash flow or profit and loss account. Would you find that in the balance sheet as well? Balance sheet is only balances, right? Okay, let me give you this answer. Loans. That's a good, very good answer actually. This is the one thing that FTA will be looking at. Which loans are we talking about? Is it the loans from the banks that we have taken, or is it some other loans? There you go. Related parties, yes. Actually, this is what FTA will be looking at. The first thing FTA will look in your balance sheet is, are there related party loans? Not the banking loans. Banking loans, okay, that's a regulated company. But staff loans also possible. They will also look at it. Why? Because some staff may be actually related directly to the owner, shareholder. So yes, but that's a secondary important thing. But you will find that majority of shareholders have injected their own money other than share capital into business. Right? Am I right? I think all of us have done that. From our own pockets, sometimes it can reach up to millions, right? The investment that we have done into the business. And how do we like to position it in our balance sheet? Whenever the auditor asks, sir, shall we give it the name of loan from director or shareholder? They say, of course, you should do that because I need to get this repaid, right? So that loan from the shareholder or director, that is a favorite area for Federal Tax Authority. I was actually doing tax strategy advisory for a major textile house of UAE. And that's where the question came, sir, what can we actually charge interest on this loan? It is, in the end, it is a loan. Can we charge interest? Why? Because if I charge interest into the loan, it will allow me to deduct some expenditure from my profit and loss account. My profit will go down. I will pay less tax. Can you think of the answer? Is I mean, I'll give you a hint. There's not a very hard and fast answer for that. Yes, we can charge interest on it. So, and that interest should be less than market value, or at least, if we charge interest on arm's length basis, your view is that it will be allowed.
We cannot, because if we have not been charging all these years, and if we just charge now this year just to avoid the tax, and it may come into avoidance of tax.
Okay, that's a good answer. Let me ask something from all of you. My company has maybe an annual turnover of 20 million dirhams. Okay. And the loan that I have in my balance sheet that I injected over a few years is already 30 million or 50 million dirhams. Do you think FTA will have a problem with this? Any views? My turnover is hardly 20 million, but the loan that is being reflected in my balance sheet is 50 million dirhams. Okay, so if the shareholder, see what Mustansar just said is that maybe there is a logic behind it, that such an excessive amount of loan is being reflected in the balance sheet. Maybe the company was suffering loss making. It was trying its hard to break free of the loss making scenario. That is why the shareholder had to inject a lot of money into the business. That's why the loan shot up. That's what you're saying, correct? Now, if it is a loan, we can charge interest on it. That's what you said, right? But could that shareholder or the business owner gone to a bank and taken the same amount of huge loan for a 20 million dirham company? Can you please answer this? It was impossible to do that. If you had gone to a bank telling that, look, our company's turnover is hardly 20 million or whatever, I need a 50 million dirham loan. Do you think any bank in their right mind would have honored this request? Forget 50 million, 5 million dirham loan. So that is the criteria, guys. If arm's length comes in, as you rightly said, then benchmarking also comes in. Benchmarking means that we have to look at outside the box. We have to look at the ground realities. So all of those shareholder loans. Let me ask you another question, as if I am FTA. I'm going to ask you something. Okay, you claim that this is a shareholder's loan. Show me the deed of the loan, please. What are the terms of payment of this loan? What is the EMI? Do you guys have that? EMI, equal monthly installments. Any indication of how you have worked out the interest rate of this? What is the collateral against this loan? None of that is present.
But it's showing in my bank statement.
So this is what it is. The fact that you tried to sell it off as a loan and charge interest on it is completely clean bold. It's going to go out of the window. So please understand this point, that this was one example. Okay, let me ask another example in the balance sheet. So let's say Mustafa Bhai or Mr. Errol or other people who have multiple entities. Okay, those companies were transacting amongst each other. One company was selling to another company, other one was buying, right? And the seller company in their books, when they sell to their other group company, what should they recognize? A receivable and revenue, correct? The receivables would be there. Do you think FT is going to think about those receivables? And do you think they are going to consider only 2024 or the closing balance sheet of the last year? In your view, what are they going to look at? Their first question will be that what is your 2024 balance sheet saying for these intercompany receivables? Or they're going to go back and they're going to ask that, look guys, that's good. I mean, you've prepared your 2024 financials, excellent. But I want to see how much collection actually happened for the opening receivables that started off from 2023. So don't you think FTA will be concerned about it? How much money landed into your bank account? Why do I say that? What if the business owner was overpricing those intercompany sales and purchase transactions? What if something that you could have sold for 10 dirhams, you were selling to your other group company for 20 dirhams with an intention to book more revenue in your seller company and increase the cost of goods sold of your other company? Why would you do that? Why? Because this company already, the seller company has a lot of loss. You can absorb higher revenues easily. But your other company to which you are selling, it was already a profitable company and you were worried, gosh, I may have to pay a lot of corporate tax in this company. So let's do one thing. Let's increase our sales prices. So if we increase our sales prices and book higher revenue in our books, my other company's cost of goods sold goes sky high and the profit will drop. That is the mistreatment that group companies can perform. So don't you think that the opening receivables will be relevant of 2023? Did we check that? That's the question that the tax practitioners like me have been stressing upon for the last 2 years. Look at your 2023 financial statement. Look at the balances, the balance sheet, opening balance sheet. Because did you know that one of the most important provisions or requirements of corporate tax law was that your opening balance sheet has to be on arm's length. It has to be compliant with the fair market value. You cannot book overpriced receivables in your balance sheet. So anyways, in short, I will close this point that get your tax story straight. That means start not from 2024, but go to an expert and start from the review of your 2023 financial statements. Before I go to the next point, I will allow anyone, if you have any questions to ask on this, please ask away. I'll be happy to answer.
So if suppose the company which are interlinked, there is a new company and there is no history of 23 and 20. So in that case, how will it work?
Then it is safe.
Okay.
It is better. Why? If it is a new company that was incorporated in 2024, you don't have opening balances really to worry about. Then this get your tax story straight does not apply to that, because they are creating their tax story from the year 2024 itself. So thank you very much for joining us. We'll be meeting for the first time. If you would like to share something on this, I'd appreciate it.
I want to ask that, suppose we have started one new company. We have started one new company.
Okay.
And we have not registered in corporate tax, and penalty has been incurred on our new company
Okay.
of 10,000, as we all know. So, and no transaction has been done yet in that company. So does that fine can be waived? Is it possible?
Sir, very honestly speaking, there are very limited, very rare circumstances in which FTA would even consider waiving that fine. The reason is that this matter has been advertised by Federal Tax Authority extremely aggressively.
Yes.
Everyone in the world, whoever was registered for corporate tax, they clearly knew that these are the deadlines that by which you have to register. But people didn't bother. And today, even today, yes, absolutely. Even today, some companies are not registered. I will be very honest with you, chances are very, very minimal that this penalty will be waived off.
So how much is the penalty?
10,000 dirham for
Straight, there's no
non-registration.
discount, nothing.
Yeah, nothing.
The thing
No.
is that nothing has been done yet. No transactions, no business, nothing. Only the company has been registered.
Sir, the whole point is that you have to think from the mind of the Federal Tax Authority, right? What is their mandate? Their mandate is very straightforward and simple: to increase the revenue from the land of the UAE from taxation, fiscal revenue. And we will be fair in that. They also claim that. So we will advertise, we will extensively and aggressively advertise and give all the opportunity. But then what is written exactly in the law? If somebody objects or claims something, we will refer back to the law, what is written in that law. And if that law supports their claim, only then we will acknowledge or consider. If it does not support their claim, we will not acknowledge. And the law is very clear, sir. Law does not give any waivers or exemptions if you did not have any activity during the year. It is silent on it. So because of this reason, FTA will revert back to you saying that, sorry, that there is nothing provided in the law, so you have to pay this penalty.
So you mean to say those who have been registered with with the company that is with DED or wherever it is. So FTA has sent individual messages to those companies to register.
See, FTA does not send messages to asking companies to register. But having said that, FTA does have data about your VAT over the last 6 years, right?
No,
So,
when the question comes that they have advertised about registering, there are chances that it may be a fault on FTA's end also, because when they say the law is getting implemented and the companies which is registered in this land, they have to intimate in person that this law has been implemented. So the person who is going to debate about this can always come with a claim saying that I was not intimated.
So, sir, let's put it to a different angle. In the entire VAT or corporate tax law in UAE is not very old. It's hardly 6 years old that VAT is there.
VAT.
It's only been 1 or 2 years for corporate tax. They're very new law. But what about those societies or economies which are as old as 200 years? Taxation has been there for the last 2 centuries. UK, for example, which has the largest treaty network of the world right now, double tax treaty network as well. The way that they have done things, these things, that's how the Middle East region is also doing it. So the law, the predominant practice accepted in the courts of law even is that the revenue authority of that country does not leave any stone unturned in their effort to reach out to the masses or letting them know and have a clear track record of this activity. And FTA has done that.
Yeah.
Chamber of Commerce, you have the license of Chamber of Commerce, correct? All the people who has got the license of Chamber of Commerce have been intimated by the email which has been registered in the Chamber of Commerce. So it's already been intimated by them. Yeah. So you have been intimated directly or indirectly. You have received an email from them for the corporate tax also, and also for the VAT before, and now corporate tax also. So it has been intimated by them formally. It has been there.
My next question is with regards to the intercompany or this one. If it's an ongoing transaction, and for example, let's say in 22 and in 23 as well, there is a instead of receivable, it's a payable. Okay, so does again it attracts the FTA's attention to such transactions? Because
Thank you very much for asking this question. Let me, if you guys didn't hear what he was saying, that is it only receivables appearing in the balance sheet, intercompany receivables, related party receivables, that would attract the attention of Federal Tax Authority, or is it also payables? So, sir, the answer is very simple. Why would the receivables attract attention? Was because of the revenue. Receivables are created against revenue, and vice versa. Those intercompany payables are created against expenses. So that means, yes, it will attract the attention because expenses will hit your profit. So thank you very much for asking this question. I'm going to move to the next matter. First, I address the opening balance sheet or the balance sheets only. What is the next thing that we do after the discussion on the balance sheet? The very next thing is your income statement, right? So in the income statement, there are different areas that Federal Tax Authority is going to look at, starting from the revenue bit. You might have heard that there are very few types of income that are actually exempt in the UAE corporate tax. One example is dividends. So if it is a dividend received from the local company, it is exempt. Or if you have done some foreign investments, even from the company's platform, they may be exempt. In the expenses bit, however, there are concerns. So first concern was any expense that you have incurred with a related party or a connected person. Now, people might not even know the difference between what is a related party and what is a connected person. So just to clarify in easier words, related parties are usually entities. They can be human beings as well, but connected persons are, as the name is very, dramatic, right? He's connected, right? So that negative connotation is there. So connected means a person of influence who can exercise influence on the company, basically. It can be the shareholder, it can be the director. But do you think only those who have invested money or are directors, are they the only connected persons?
Yeah, the relatives of the shareholders.
Relatives of the shareholders, even the cousins.
I think the 4 degrees of kinship.
To 4 degrees of kinship, not father or grandfather or great grandfather, great grandfather. From if you have a common great grandfather, so that's we're talking about 2nd degree, 3rd degree cousins. They are even considered as connected persons. So if they are employed in your company and you're paying them a salary, so we have to make sure that the salary is within the amounts of reasonableness. Now, that is fine. I mean, that is subject to debate. But what about those situations? Thank you. So what about those situations where a housewife is sitting at home and she's being paid 30,000 dirhams per month salary, or father or mother, or for that matter, any other relative? Boss, this is what is happening actually right now. And tomorrow, if you have filed your corporate tax return and God forbid a tax audit opens up, there will be a probe into your staff costs, salaries. And even if your better half or your son or daughter is genuinely spending time in your company, they will still be looked at. So you will be able to defend. Why? Because they're genuinely doing work there, and auditors are fair. FT auditors are not extremely unfair. They're quite fair. So they will find out that, okay, these are actually working people from the family, no problem. We can condone the salaries that have been paid. But if they find,
even though they don't have the labor card.
So that's a good question. Until now, the condition of labor card has not been specified in the UAE corporate tax. To my knowledge, it has not been specified. You
If
can
they are
put,
not there in the labor card, it means they are not your employee.
yes,
So how come you are paying salary?
let me explain, sir. You want to say something?
Trade license if they are not, then it is.
नहीं, लेकिन जो नहीं है, who is not in trade license, but is working and you are paying salary to them.
But WPS?
So if they are not in the labor card, how you are paying WPS to them?
Sir, let me explain to you. Let me explain to you. First of all, we need to understand why are we asking this question? The answer is that we want to analyze whether this is a deductible expense or not. Am I right? Correct? So just to answer your question on a very easy way, even if you've named an expense as salary, and if it were actually not salary per se from a labor law perspective, but it was genuinely incurred for the purposes of business, wholly and exclusively for the purposes of business, no matter what name you give it, it will be deductible, accepted by FT. The condition is not the name. It can be salary, it can be staff cost, you can call it anything, you know. But the point is, if your expense is genuinely incurred for the purposes of business, wholly and exclusively incurred for the purpose of business, these are the words of the corporate tax law, it will be accepted. So there's no specific provision on salary. Yes.
So will a contract be a sufficient document for FTA?
Yes, it will be. Contract, yes.
IT company sometimes call contract people to work. We hire on a daily basis, we hire some individuals. There's a valid and sign. And when we pay them that money on a daily basis, we sign and receive from them. In the result of this particular invoice number, again, it is.
Think of me as FTA. I'm going to ask you the counter question as Federal Tax Authority. I am not, but I'm going to ask you, is this expense incurred genuinely, wholly and exclusively for the purpose of business? Allowed. Simple. So, madam's question is that if we have outsourced staff sitting in India, sitting in Siberia, Mars, wherever, and we are paying them something and we're calling it salary or contract, consultation fee, anything at all, as Federal Tax Authority, my question will be very simple to you. Is it wholly and exclusively for the purpose of business? Is it genuine expense? Is it fair value, fair market value? If your answer is yes, it is allowed as a deduction. This is, see, the legality of things may have lesser potential here. What is more important is the business and economic rationale of it. If it is wholly, yes, that's a good point. That's a good.
The practice even some time back. Yeah, and obviously the VAT is not there for the outside payments of those ones, so it can be justified.
Yes, very good points.
This is what my experience is. Most common question that the company and the staff or the directors, they say that can you start charging the salaries of the directors to make up that expense of the tax return, and that is coming from everywhere.
So that answer is again,
even
sir,
before they were not charging the salary for the directors or the owner, but you could adjustment of the expense and to show the less profit. It is the most common question.
But it is not, it is a fact. It's not less profit. Before, they were not charging because they were considered as a withdrawal. Right now, we are forced to charge because they are going to charge.
They are not charging even.
Yeah.
But now they have to understand the scenario to reduce the.
So because now they are going to
Now
charge
they are
tax, so there is nothing wrong in charging the salary for the director. If you are having a director employed today or from outside, he is going to work for you free.
But before they were not charging that also question comes
So
up.
So that is,
that
sir,
is what it is.
And
That was
also
taken
they
as
were
a
saying
withdrawal.
that, can we start charging at 75,000 dirhams for that one? Then it does not come up that maximum, any staff is taking 20,000 dirhams and they will start charging 80,000.
so it's a genuine scenario. Again and again and again, I have incurred this point. And Mr. Mustafa is right in saying that, okay, because now corporate tax is there, we did not know earlier on. That is why it was not happening, but now we should start charging. That's a very important angle to consider. Guys, this is why we are holding this event actually. While his answer is right, in the new era of corporate tax, we can start paying salaries or charging salaries for the directors. But the question is our tax story straight? That's what I've been telling from the day one. So if it is an unregulated business, if it is a business that is not a listed entity where you have to file your financial statement, etc., that's why I was telling you that go into your last year's account and start this story from there, not from 2024 only.
But then you cannot start from there because you were already paying VAT at that point of time. So that those expenses which for the VAT, when you have already filed the VAT, this were not there.
Sir, it is
How you are going to start from there?
correct. Let me answer this in a subtle way because this is a very sensitive area. And I don't want to be on air saying things which will be, on record and, I'll be caught up later on. So I don't want to say this in that sense openly, but but we can definitely have a detailed discussion off record on this matter. But while you're right that if we book director's fees from the last year's financial statements, VAT implications would come in. So let me solve your problem right here and now. Director's fees through a notification from the federal tax authorities was made out of scope to begin with. So you don't need to worry about the director's fees attracting VAT.
In any case, VAT is only what you are claiming is what you are paying, nothing else. VAT is nothing.
But
there is
But
no
director
profit.
fees never came under the
Never into VAT. VAT is very simple. It is what
In-
you are collecting is what you are paying. That's
in
it.
the initial stages of VAT in 2018, director fee was, very much alive in the VAT discussion. It happened recently, I think 2 years back or so, or 1.5 years back, that director's fees was sent out of the scope of VAT law. So no longer VAT is applicable on the director's fees, but it is a highly sensitive topic, the salaries of directors and shareholders. And I sincerely, if you don't want to talk to me, don't talk to me. But I'm going to stress the need of it that you talk to whoever your tax consultant is. Because this story of paying salaries to directors or shareholders has to be straight from the last year. Otherwise, the question will come in. What the hell? I mean, for the last 5 years, you were not even paying salaries. Suddenly, you remembered that we should start paying salaries. Why? Because our tax is, going to drop.
Obviously.
Sir, that's what I'm telling you. This will be a question mark in front of FTA.
No, it should not be a question mark because at that point of time, we were not charging because we were just withdrawing as a capital or just thinking that it's our own income. Now you are going to charge tax, so we are booking it as an expense.
Okay, I respect your view.
But
But
even
there
then,
is a-
sir, when you were taking that time, was it not charged as an expense?
No,
It was not.
Where
it
was,
wasn't.
where was it?
It was charged to our capital account.
Director spread account or the shareholder account.
Yeah, exactly.
Sir, that's
Exactly.
even a more dangerous thing to say. I swear to God, this is even a more dangerous thing to say that previously our salaries were charged to directors or shareholders account. And I sincerely advise you again that this matter, those people,
They will open up another Pandora box.
if you were not charging the salaries in the previous year, you would have, sailed away. But if you were charging and you were charging in shareholders account,
Any withdrawal hota tha na, there was withdrawal happening.
Ah.
Correct.
I get your point. So
There
withdraw.
was withdrawal happening. Probably we were not charging it as salary in the name of the salary, but there was withdrawal happening. For example, credit card payments were happening. They were personal expenditure. So where this personal expenditure will taken, it were taken to the capital account.
So anyways, the whole point is this is a very sensitive area and of high importance. And you should document your discussion with the tax advisor on this, so that tomorrow, based on his tax advice, you are subjected to any penalties from FTA. You can go back to the person and say that you gave me this advice regarding this matter, and now I am facing a penalty. You should hold your tax advisor accountable. Yes, sir, Mr. Sansar. Your question is that if you are a partner or shareholder in a company, salary account as in a general ledger account in the books. Yeah, you can have it. You can call it a director's salary account. You can, that will not, it's not a huge, how you record it it's not highly risky or anything. So these are two different accounts. So director's current account or liability account or loan account is a balance sheet item. Whereas the other side of this account is a profit and loss account item, which is expense. So if you didn't want to actually pay the salary to directors in cash, one easy way is book the expense on it and credit your liability or loan account of the director in your balance sheet. One easy way of that. Anyways, so we discussed about the balance sheet. We discussed quite a few things about income statement, and thanks to Mr. Mustafa Pankhawala, a very seasoned businessman of UAE, he even brought into picture the statement of changes in equity, which is ignored. People are not even aware that there are movements happening in the statement of changes in equity, and those movements may be subject to corporate taxation. So this was just one example which Mr. Mustafa quoted. That, for example, last year, those salaries that we were taking out, withdrawals, we were recording them as drawings from our statement of changes in equity. This year, we changed their presentation from drawings to expense. Guys, I swear to God, this is the difficult area. You guys need to have a word with your tax advisor on this, because last year, if you were doing it as withdrawal, this year you're doing it as expense. It's a clear-cut red flag. Clear-cut red flag. Anyways, we've talked about, yeah.
Company's perspective, whether it's drawings or whether it is expense, ultimately the effect is going to come in balance sheet, right?
No, sir, it will come on profit and loss account. Think of it.
Profit and loss is post balance sheet.
Yeah, but how do we levy tax, sir? On the net profit before tax, right? So that profit before tax will be affected if you
reclaim. What is about balance sheet? When they first come in, they should go from balance sheet to P&L, not the other thing.
So, sir, this is.
When you said when we opened up the debate, you said the first thing what they will go into is balance sheet. Right?
Yeah, I mean, yeah. They will not even go on the balance sheet. They will first go to note 1. That's what I said. Why note 1? Why? Because the whole corporate tax law of UAE is designed in such a way that the first phase of corporate tax assessment or impact assessment or tax assessment does not start from financial statements. It starts from assessing your personal status. That's the first phase, not the financial statement. So from financial statement, note 1 is the place which gives the answer to this question. Like, are you a free zone company or an LLC, or are you simply a sole establishment? Huge difference. Sole establishment is seen as natural person, but LLC, free zone establishment or other formats, they are seen as juridical or legal person. Complete change in the income, in the assessment of income. If you are a corporate body, your worldwide income is taxable. If you are a sole establishment, which is a natural person, you don't need to worry about your worldwide income. Only that level of income will be taxed, which you have earned from UAE or through export. You may have a branch operating in China as a sole establishment or as a natural person. That Chinese branch will not be taxed. Yes, sir.
It will be 1 million, right?
Correct. Yes. So the threshold, threshold is 1 million dirhams for a natural person. So if it exceeds 1 million dirham in revenue terms, it is taxed.
How about for LLC?
For LLC, very interestingly, I was asked this question from many people. So, sir, our revenue is not there. We have just started off with the business. Just now you mentioned it.
And that is Alfred company, I mean, free zone.
A free zone company he set up. No transaction has happened. Bank account is not opened. Is this company subject to corporate tax compliance? The answer is yes. It has to register. Doesn't matter what you do. If the company is dormant, I will go to the extent of saying something even stranger. This was a free zone company, right? Okay. Free zone establishment, that was also a red area. Some people did not understand it earlier on and they said, this is similar to sole establishment. So let's not register. But when you look into their memorandum of association, you find that this free zone establishment has a separate legal personality. So it is a legal entity. It is not a natural person. But as I was saying, I will go to the extent of asking a very strange question. Offshore companies, gosh. What do you think? Offshore companies, by law, they are not allowed to do business in UAE, right? Are they subject to corporate tax? How many of you have dealt with offshore companies or have your own offshore companies? Are they subject to corporate tax? Can somebody tell me? Offshore companies. I have a friend, I have multiple friends actually who have just, there's a lot of influx from UK and US happening in UAE right now because of the, inflations and whatnot. And I got a frustrating call from a friend of mine saying that, Altaf, you just made my life miserable by telling me that all my offshore companies that are there in Jafza, they are offshore, man. How the hell can they be subject to corporate tax? They're not even allowed to do business in UAE. So I said, so thank you very much that you at least listened to me and did your own research and found out that what I was telling you was the truth. Even the offshore companies registered with Jafza or REC, ICC or any other place, Ajman Free Zone, are subject to corporate tax. They also need to register. And this is a unique situation. All around the world, offshore companies are offshore. They're not onshore. They're not considered for taxation. In UAE, this exception has been created. Offshore companies are still subject to corporate. Anyways. So, sir, the reason is very simple. Actually, this is what we sow, so shall we reap, right? So many people opened their offshore companies in Jafza, just like that friend of mine. I'm not going to name him. And he was doing worldwide business through that company. Doing business from an offshore company, which was not allowed to do that, right? Yes, out of UAE. But the point is that this was an entity hosted by Jafza, which is a free zone. So in a way, I mean, UAE is of the view that not only that scenario, but people are doing certain business activities in the UAE also from the platform of those offshore companies. If they can prove that, then they can set up a case. But unfortunately, still registration will be needed. Still filing of the return will be needed. But since you're not doing business. However, one tricky point for us to remember, and this is a downside, sir. Actually, you raised a good point. What do you think that their worldwide business that is happening there out of UAE? Do you think that will remain out of the scope of UAE corporate tax, or will it be taxed? Remember, guys, scenario that this is an offshore company and it is doing business around the world, buying from China, selling to Africa, Europe, wherever. That entity. First question was, does it need to register for corporate tax? The answer from majority of you was that yes, it is needed. Second question is, since they are not doing mainland business or domestic business in UAE, only international business, third port sales, high sea sales, that revenue, is it subject to corporate tax in UAE? That's my question. Can somebody answer?
If revenue is coming in the UAE banks, then yes.
If revenue, there's a conditional answer. If the revenue is coming into UAE banks, then yes. Anybody else?
If the person is residing in.
Sir, this is a key point. I will come to this. This is a key point that Mr. Naveen has raised. He's an ex-finance guy as well. Excellent knowledge of it. But let me give the simple answer to this. Unfortunately, the worldwide revenue of that company will be taxed in UAE. Unfortunately, it beats logic, but it will be taxed. Unfortunately, that is the law. You can ask about why are they doing it, but they are doing it. Unfortunately, now coming to a very important point, which incidentally or accidentally Mr. Naveen raised. He mentioned if the shareholder, the owner of the company, is living in UAE or an offshore company, then that company would be a resident. Sir, I will simply say it will not matter where the shareholder lives. If this is an offshore company registered with JASA, it is subject to corporate tax. It will be a tax resident. But I will go to another angle. What about those companies which you have out of UAE, in China, in India, in Pakistan, and the shareholder or the ultimate decision maker is living in UAE? In your view, those foreign companies, do you think they are required to register in the UAE? Yes? I'm looking at the expression of Mr. Mustafa. So, Mr. Mustafa, what is your view? Do you think those companies should be registered in UAE?
It's not in the existence in UAE.
It's not in the existence in UAE?
Yeah, why it should be registered in UAE?
Okay. Kalima, can you please come here? Kalima Misbah is my brilliant tax manager, assistant manager. She beat a PwC manager in the corporate tax impact assessment that a competition that I was holding, and she stood first, so I immediately hired her, clapping for her. Kalima, this is a question and this is a debate going on that some of Mr. Mustafa believes that those companies do not even exist in UAE. Why the hell should we register? They are foreign companies.
But like we mentioned, the shareholder is a resident in UAE. And like society raised that if he's a resident, there's a provision of place of effective management. He's going to manage his companies residing in UAE.
You remember the article? Article 11.
So point that comes into place here, that's why they have to register.
Thank you very much.
How about, sorry, please go ahead. So if this company is registered outside and the tax is paid in the other country, still we have to register it here?
Yes, still we have to register, but there is a relief available, which is called double taxation relief. Okay, you will, everybody understands Urdu, Hindi, right? Most of us, there's no, okay, तो मैं एक बोलूंगा, एक वो कहते हैं ना गुंडा, ठीक है, जो रेवेन्यू अथॉरिटी होती है ना, वो अपने मुल्क की बदमाश होती है, सिंपल सी बात है. Wherever you are registered, sir, it's a light-hearted humor. Revenue authority is the boss, right? You can't do anything. Revenue authority will take the money from you if your company is registered inland. So that country where your company is registered, Revenue authority will take money from them.
Correct.
That's where the good FTA comes into practice. They don't want to penalize you. FTA, ZATCA, these entities.
Identify that we have a company.
Sorry?
How do they identify that we have a company unless and until we declare?
Sir, this entire regime is a self-assessment regime. Self-assessment means that the revenue authority openly says to the taxpayer, we trust you. Unless and until you give us a reason to not trust you. So that is why whenever we file our corporate tax return, it by the action of us clicking that button of submit, that becomes a legal assessment order of the taxpayer.
And how about if the company is making loss? Then what happens? I mean, what kind of tax implications are there?
If the company is making a loss, then the loss provisions are very detailedly identified. You can carry the loss up to infinity. Okay. And even in that particular case, if you were paying some tax in another country, there is something called foreign tax credit. But the unfortunate truth about foreign tax credit is that if you do not claim that foreign tax credit in this year, the benefit of that tax paid out of the UAE will be lost. Mr. Praveen had a question and I could not answer, sir. You forgot.
So I just want to understand this more clearly. So you are saying that there is a loss which the company is making, let's say in India. And of course, there is no tax we are paying there. And we are paying on in our company in Dubai certain tax. How can we claim the loss which we are making in the other?
So your question is that you have a company in India, it is already making a loss. We are not paying any tax in India, and then we have to pay the tax on the same company in UAE.
You may not be paying the tax, but we are making loss as if we are considering three companies as one entity, then put together two companies are making losses, one company is making profit. So we should be actually, making that.
Good point. Let me. So he slightly change in the scenario. He's saying we have, let's say, three companies. Couple of them are making loss and the other one is profitable, or vice versa. And one of those companies probably is in India and it is subject to double taxation. So it's a very widespread scenario. Some of the answers I will give you. For example, there is something called a tax group in the provisions of the UAE corporate tax decree law. So if you form a tax group, the loss-making subsidiaries' losses will by default be offset against the profit-making subsidiaries. So in a way, that tax group is seen as one fiscal unit, one unit, one taxpayer. So in that sense, you will get the benefit of it. Now, who can be the member of the tax group? Only those companies which are tax resident. And when I use the word tax resident, it can be a foreign company also, located in India. That POEM concept which Kalma just identified, that company located in India, situated in India, is a UAE tax resident. Why? Because the owner shareholder resides here, controls the company here, right? So you can include that company within your tax group and save some money.
And how do we do that?
To form a tax group. So you have to basically register all the companies there and then apply to FTA. You have to position one company as the representative company for the tax group, and that's how your tax group will be formed. And then going forward, one TRN number will be applicable to all the three companies. That's how the tax group will form. Guys, since oh yes, tax group has its own implication. There's always a pro and there's always some cons to it. So tax group has. I want to share a case in point on this with an M&E under debts pillar 2, a huge entity which was earning more than 3.1 billion dirhams in revenue, and I was handling their tax engagement. And that company, we provided an advice. And this is important for you guys to understand, because this is tax strategy that I'm about to talk about. Tax strategy is when you actually quantify the proposed action that you are about to take. In your case, for example, you had three companies, you had common shareholdership, like in case of Mustafa Bhai. It was not a structure, group structure was not there, parent subsidiary structure was not there. So tax advisor told you, look, why don't you form a tax group? But there is certain actions you will need to perform. What are those actions? One of the company you will have to identify or designate as the holding company. And then the other two companies, you will go and you will need to change their memorandum of association and make them subsidiaries of that holding company. So that corporate structural change you will need to do. So that's a strategic thing. Now, the tax advisor has to calculate the overall impact of taking this action. So what are the incidental costs that will come in? Number one, changing the structure. So there is legal costs involved, the money that you will pay to the Ministry of Economy or whoever, that's an incremental cost of it, right? But becoming a tax group will avoid your transfer pricing compliances. If you are paying some money to consultants that you guys please review our transfer pricing, whatever, maybe 10, transfer pricing is an expensive area. Easily 20,000-30,000 dirhams will go away because of this decision that you decided to create a tax group. Okay, that's another thing. Like similar other things you will have to identify, and bottom line you will need to identify that, okay, this is the incremental cost or benefit of creating a tax group. But there is another option. What if we did not create a tax group? We kept those three companies separate. Why? Because the same person has 100% ownership in all the three companies. This is called qualifying group. Another scenario, right? In qualifying group, the maximum amount of tax loss that you can transfer is 75%. So you have to calculate, the tax advisor has to calculate, okay, now we are considering a different scenario. So what amount we were about to incur extra in tax group for formation and this and that. In case of tax group, we can still transfer up to 75% of tax losses from one company to the other company, and we avoid those other costs. So what is the beneficial scenario? You compare the two scenarios in numerical terms and then take a decision. Now I will share this exact situation I did with that enemy. And we came up with a scenario with the result that actually, guys, if you continue with the qualifying group scenario, there is an incremental benefit of 100,000 dirhams. It was a huge organization. So we said, go with the qualifying group scenario if you want to gain this extra 100,000 dirhams. But we need to remember that if we do not form a tax group, these three companies will stay related parties. And if they stay related parties and interact amongst and between themselves, what is going to happen? Transfer pricing will come into play. So benchmarking reviews will, do you know how much it costs to do one benchmarking review? Easily 10,000 dirhams for one class of transactions. So many things will come into play. Benchmarking review will come into play. You will need to do the transfer pricing risk assessment, you know, etc. You will need to file the disclosure form, which you anyways will need to do. But if it is a larger organization, you may have to maintain transfer pricing documentation, master file, local file, so many things, just because you did not form a tax group. That entity, what did they tell me? So Mr. Altaf, we like the analysis that you have done, and we can see there is 100,000 dirhams benefit if we do not form a tax group, but we are willing to let go of this 100,000 dirhams of benefit. Why? Because if we form the tax group, our transfer pricing risk will be avoided. And if we stay at a transfer pricing risk, the penalties, the kind of penalties we may incur, they will make 100,000 look like peanuts. So we don't want to go there. We will form a tax group, we'll forego this 100,000 dirhams worth of benefit, and that's how people move. And so many other organizations followed the same pattern. My European clients, mostly in Design District and DIC, they also followed the exact same thing. They followed tax group, they avoided qualifying group structure. So guys, anyways, this is kind of a summary of what I wanted to share. Thank you very much for coming here and joining. And if you guys have any questions, specific questions also, I would love to answer. I want you to take away something from this session, actually worth applying.
I do have
So
a question.
the corporate structure which we are talking about under the building company, there are multiple companies. It is perceived often that under the building companies, it is there, it is very well organized, we can manage, we can avoid evading any taxes in the future. But in this structure which we are talking about, it also has one position. Which one would you opt for and why?
Sir, okay, the question, Mr. Chandan, and let me tell you that he has been the CEO of Dhofar Global, which is a leading organization in UAE and Oman, if I'm not mistaken. But there are things that he's also doing, and he's moving into a different business now, mashallah, and we congratulate him for starting a new consulting venture. His question was that holding company structures can be beneficial from a corporate tax perspective, but then there is international business involved as well. How can we estimate or assess and make a conclusion that which corporate structure suits the best, right? So my answer is 5-pronged. There are 5 things that we must consider while taking a corporate tax strategy decision. And I am talking about international business and domestic business combined. What are those 5 things that we need to consider? First 2 things. Domestic corporate tax law of the 2 countries where the presence will be there. Your company, your group may have multi-country, multi-jurisdictional presence, right? So any company that you are considering to form in another country, which will be, for example, housed as the holding company will be in UAE, or for that matter, any other country as well, always consider as the first 2 criteria, the domestic corporate tax of those 2 countries, how these 2 will interplay, or that we do. Okay. Another 3rd criteria will be the double tax agreement between those 2 countries. So that double tax agreement has a unique value and power actually, because those double tax agreements have been signed under Vienna Convention, which is a law to which majority countries of the world have already accepted, agreed, and signed that we are going to hold any agreement signed under Vienna Convention over and above our domestic law. So if there is, I'll give you an actual example. There is a double tax agreement between Singapore and UAE. In that agreement, interestingly, a mistake I identified that clause says that whatever amount of tax is paid in Singapore, the UAE entity is going to give that as tax credit. Now, the funny thing is that the rate of taxation in Singapore is sky high, too high, and UAE taxation rate is, effective rate is less than 9%. That's a fixed situation for Federal Tax Authority as well. There are high chances that this tax agreement will be addressed, but by that time, people who know this, they would have dragged FTA into courts and enjoyed that benefit. Why? Because the double tax agreement overrides our domestic corporate tax law. So any subsidiary operating in Singapore can claim 37, I don't know what is the rate in Singapore, 30% or whatever. That much amount of tax they'll be able to claim here in UAE, because the double tax agreement says so. So anyways, what I was telling you was this is the 3rd criteria and a very powerful criteria, double tax agreement. What are the last 2 things that I have not said yet? I told about domestic corporate tax laws. I told about the double tax agreement. Last 2 elements, which tax advisors do not consider that easily, is the corporate law, commercial companies law, which is not there in the tax law. We're talking about civil procedures law here in UAE. We're talking about the law number 21, I think, which was issued recently in 2021 itself. This is called Commercial Companies Law of the UAE. We're talking about DIFC, ADGM laws that have been issued for incorporating companies and regulating companies. This is out of the corporate tax law. But in order to formulate that strategy, sir, these are the 5 nodes that a wise corporate tax strategist or CFO will consider. I hope I answered your question. Any other question?
There is a limit of adjusting the loss at the percentage of EBITDA, I believe. And
yeah, tax EBITDA. Previously, when the law came,
or the charge your losses at a certain percentage, not more than that, and the remaining losses you can carry forward as you said.
Right. So
what was the percentage and what is the price?
I'll explain to you. So first thing, one by one. The first point was EBITDA. So since we've been doing corporate tax way before it even got introduced into UAE, when the law came, initially they used the word accounting income. Later on in a decision, it was called EBITDA. And then finally, the latest decision, which talks about losses and what base to use, clarified that this will be tax EBITDA. A percentage of tax EBITDA, but that tax EBITDA thing is not for losses. It is for interest. That relates to interest. Coming to losses. For losses, EBITDA and other things are not relevant. For losses, rule is very simple. You can carry forward the loss up to infinity, but during any given tax year, you can claim tax loss up to 75% of your taxable income, not the tax loss carried forward. There's a confusion. Sir, this is the year 2025. We are filing our return. Last year, our tax loss was 100,000 dirhams. So can we claim 75,000 dirhams? Why? Because this is 75% of the tax loss that we have carried forward. The answer would be no, you cannot. You have to look at your taxable income of the 2025. To that extent, 75% of that taxable income, that's the upper limit you can offset. Rest of the loss you can continue carrying forward. I hope I answered your question. Any other questions or points? Well, thank you so much, gentlemen, for coming here. I am going to request Mr. Musa Milhan, who owns Mills Cafe. He is very kind, and a big round of applause for him for hosting us and giving us this service. We can conclude this event by saying a few things about Mills and us.
Yeah, thank you everyone for joining here. And appreciate that. Okay, everything that's given here is still clear because, as Lalta was said, because it's a month of break. And going forward, it's not going to be a light moment by the FTA. And as taxation law and then the corporate law is being used long back and the corporate tax has been very sticky from the last year. So it's a very decision by Lalta, and everything is very clear. So everyone should have one separately with the so to get the benefit of it. Yeah. So thank you everyone for joining. Yes.
First of all, thank you on the members and the guests for being invited to media. And it's an amazing session where we had a lot of insights. I think everybody who was there today will agree that he is a person of high level of knowledge. And the clarity which he gives to each and every question is remarkable and it's quite appreciable. We once again thank you on behalf of the entire Indian Gladiators family.
Thank you very much.
Thank you.
Thank you.
Like what type of connects you are looking for? How can we help?
Right. So guys, thank you very much. This is Mubin Zaman, a dear friend of mine. Today he is curating kind of the videography of the event without even asking me. Thank you very much, Mubin bhai, for doing this for us. Sir, I will offset it against the tax advice. Done, sir, done. So, so anyways, the kind of connects that you guys can bring to me are probably those entities who have more than one entities, multiple entities that are there. Those entities which are touching 50 million dirham per annum turnover, because that would be the right kind of company that would need my services. And majority of those usually would be cross-border. Any entity that reaches that 50 million dirham threshold usually has a presence in maybe Saudi or Qatar or any other country. So if that kind of a connect you could introduce to me, I would hugely appreciate that. With these words, I thank you one more time for coming here. I hope you've taken your tea, or it is still there, I think. Thank you very much. Give yourselves a big round of applause and thank you so much.